Thanks for joining us. I'm Sarah Michaels with Oxford Analytica, and I'm in conversation today with Dr. Stephanie Hare. Stephanie is our senior Western Europe analyst and has been closely following the developments in Italy, the implications for the euro area, EU institutions, and for market reactions. Now, Stephanie, in this studio 1 week ago, we were talking about the collapse of the Greek government. The focus, quite appropriately, has shifted to Italy, and we're now looking at the second government in the euro area to fall in the space of a week. But Italy is actually much more important than Greece.
That's right. Italy is the third largest economy in the euro area. Greece contributes something like 3% of GDP to the euro area, just to give an indication of the scale of differences. So what we're going to be looking at is the fact that we've got a political situation to resolve, but also concurrently there is financial pressure that is turning into a crisis too. So first, the easiest to resolve in the short term is going to be the political crisis. We've got three options for a government. The first could be some sort of reconstructed coalition based on the parties that are in parliament now. The second is a technocratic government, which would be appointed by the president of Italy. And the third is having snap elections, and those could be held within something like 60 days. So we're looking at December.
How do you rate the possibility of the emergence of a government that other EU interlocutors and that markets will regard as credible?
At the moment, the most credible solution would be a technocratic government, and this is widely tipped to include former European Commissioner Mario Monti. That is something that I think both markets would find reassuring and other EU partners.
And what about the implications for the EU itself? Will the euro area remain intact?
Well, there's been a lot of speculation at the moment that having yet another country, this would be the fourth country that could potentially require a bailout, though certainly not immediately, that this could be enough to break apart the euro. And I think that we need to just be calm at the moment. Italy is far from being insolvent. This is a liquidity crisis. At the moment, the European Central Bank can continue to supply money to guarantee Italy's banks. So that's not really the issue in the short term. Also, we've already had scheduled a conference that's going to be held, an EU summit in Brussels in December, looking at options for closer economic governance. So if anything, it looks like the German Chancellor and the French President, Angela Merkel and Nicolas Sarkozy, are wanting closer European integration, not a breakup.
And as for the market reactions, has there been an overreaction?
I think it's normal that there's going to be this kind of panic and churn when there's this level of political volatility. I mean, to have two governments collapse in the euro area in the space of a week is obviously unprecedented, and it's certainly shocking in scale. That said, if it's resolved quickly, what the markets don't like is uncertainty. So if we can get two credible governments in place within the next week and get back on track talking about boosting the bailout fund, recapitalizing Europe's banks, and dealing with debt in a credible way, it is possible that we could sail through these rocks.
Well, thank you for ending on that relatively optimistic note, and thank you to all of you for watching. We look forward to your feedback on our coverage of the euro area debt crises in the Oxford Analytica Daily Brief, and particularly our coverage in our 2012 Prospects series, where on the 24th of November we will be publishing an article looking at the shape of things to come in 2012 for the euro area. This is Sarah Michaels with Oxford Analytica. Thanks once again for watching.